Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hi Chris, good to see you again.
Yeah, good to be here, Lee, despite the rain outside. I feel positive today, despite the market discussion that we're going to have.
Yeah, exactly. There's a lot of news around, isn't there? Tax breaks, inheritance tax. What's the government going to do in the October budget? But we're going to leave the speculation to the internet. We're going to talk about some really good companies and try and demonstrate that AIM is more than just a tax break, aren't we?
Absolutely, yeah. I mean, it's just been miserable for small caps and AIM, and the pressure lately has been worse because of this fear around business relief being withdrawn on AIM shares. We're going to focus on the companies, the business, the profits, and what they've been delivering, in many cases, in fabulous share price returns, fabulous share returns. And these are all AIM companies we're talking about.
Yeah, some good stories, some good companies. Also some, as you quite like to put it, some tiddlers that may go on to become the next sort of champions of the next champions, no pun intended, champions of AIM.
Yeah, even those that have delivered incredible share price growth are still small. They're operating in vast markets, and they could be multiple times their size, still be small constituents of their market. So there's loads of growth still to go for, and as we will demonstrate.
Yeah, so we'll leave the speculation to the internet and we'll just get on to the real fact. And the facts being the results that IPO Group has just published.
Yeah, I mean, brilliant. This is an independent supplier of gas and electricity. It's been through a real roller coaster, and it just, it highlights what you have to expect. You invest in smaller companies. So it joined the stock market at a point which wasn't that easy. Its business model was less well established. So it listed in 2016, £1.85, and it had a near-death experience in 2018. So it's only 2 years later. It had accounting issues. And then by March 2020, pandemic, energy prices through the roof, had another near-death experience, and the shares fell to 56p. So people in this stock, £1.85 listing, 56p. The current price is £14.61. People have done rather well, 689% return in 8 years. That's compound annual average growth rate of 29%. So this stock, you'd have lost your shirt over this period at some point. However, if you'd have stayed patient and really followed Bobby Callard, the founder of this business, who owns 51.6% of this company. So he's been fully committed. We love founder owners. Old Bobby's done pretty well here. It's just announced terrific results. Its market capitalization now is £247 million. This business listed, what was its market cap? I think it was 26 million. So it's now 247 million. Had to raise a little bit of money to help it along the way, not very much. But last 6 months, revenue climbed 60%, 60% revenue growth. Pre-tax profit more than doubled to 20 million quid. This is just for 6 months. And it's supplying more energy to more customers. It's got a smart metering business as well. Operating cash flow is fabulous because it's been allowed to repatriate some cash that it had to lodge as collateral with one of its energy suppliers. The dividend, wait for it, dividend up 500%. Wow. And this business is not highly rated. I haven't got to pay much money for this. It's on a forward P of just 9 times. And old Bobby took that, and the dividend now yield is about 3.6%. And CEO and founder Bobby took the opportunity to really vent his frustration at the lack of, he called it, institutional engagement in his business. So a lot of institutions aren't interested, despite, quote, management delivering colossal value year on year. Well, you had that bit of a dodgy period, but yeah, it's not far wrong. And he's getting a bit fed up, and I'm not surprised. But look, great story. But what did it need? It needed patience. It needed some understanding of the business. It needed faith in the founder who's still there. And hopefully this business is minuscule. Its market share now has gone from 1.4% to 1.8%. Crikey. It's got a lot of growth to go after. So yeah, IPO Group, one that people should be looking at, a positive news story.
Does fundamental own it, or is it in any
all of the
IT
stocks here
portfolios?
we hold, or I personally hold personally. So it's all in fundamental, our associated businesses, AIM portfolios. IPO Group is more recent addition actually, but a lot of the others we've held for a long time.
Yeah. So the next one that fundamental owns then is Elixirr.
Yeah, this is sort of a management consultancy. There aren't many on a name like this now, actually, and it's led by a very ambitious CEO, another founder, big founder ownership. He's got 20 odd percent of the business. A guy called Stephen Newton is CEO. The rest of his founding partners, they own a combined 56%, all of them. See, look, fabulous alignment. These people are really well aligned. And Elixirr is valued about 300 odd million pounds. And it's just been growing terrifically. Again, this week, great results, pre-tax profit. These were interims again, up 22% to 12 million. And that was after even some questionable share-based payments, which we don't like very much. Great cash generator. It's using cash to acquire other related businesses to add more skill set to its consultancy services. But yeah, Stephen, I think, drives things pretty hard. But look, again, it's delivered fabulous returns, 200% return just over 4 years. That's compounded annual average of 32%, which is brilliant. Listed at £2.70 now, £6.60. It's been higher. Big founder ownership, great entrepreneurial drive, founder still running it. We'll briefly mention where this can go wrong later on. But yeah, this is the common theme often with these businesses. So this is good news. Another good news story.
Yeah. Next one, Fonix, mobile payment
Fonix.
specialist.
Yeah, a lot of people have come through. This facilitates the payments through your mobile phone. So if you've given money to children in need or something, you'd have gone through Fonix's platform. That's just one of its charity clients, but it deals with a lot of the broadcasters. Again, just around fabulous results when a lot of companies have been struggling. Only got 50 people in the business. Market cap's 230 million. It's now expanding overseas as well. Pre-tax profits rose 27% to 14 million. This ticks the box for us as well. 100% return on equity. So this business delivers terrific return on equity capital, which is what you want to see. The founder sold down on IPO. There was a big sell down when they came onto AIM, but he still retains a 19% stake. And the founder sold down over time. See, the really interesting bit with this business, and I would commend other people to look at it, which is the CEO's salary, Rob Veace's salary. I mean, he gets a basic 170K and then no annual bonus. So his upside is all linked to his equity stake, the increase in value of his equity stake. He owns 6% of the business, but if those share price goes up, his 6% is worth more. And that's seen him offload a few shares as he goes along. 6% is still a big commitment. And that's incredible. I think I've seen that before. A lot of companies have big option arrangements and obviously a lot of big bonus rewards as well. And that's been a real complaint about smaller companies, and a big complaint of ours as well, actually, that the remuneration of CEOs and the board of smaller companies is way overweight relative to the return the business is making. I mean, a lot of big blue chips get a lot of complaints about fat cats, big salaries, but that's generally a pinprick in the returns that they're making. With a lot of smaller companies, it's far more significant, but with Fonix, which has delivered, it's a very different pay structure that, and really impressive.
Yeah, it sounds like his pay is linked to the growth of the company.
Perfectly aligned, and no funny option stuff going on either. It's just the perfect alignment. He's aligned with all the other shareholders. And that salary isn't huge compared to what we see with many other businesses.
Yeah, you can see why he probably does sell down his shares from time to time as well.
Yeah, and good on him. It's delivered in spades, barely put a foot wrong. So listed at 90p, now £2.24. You've had lovely dividends, growing dividend. I think the yield's about 3.8%. So the dividend's been growing consistently since IPO. But yeah, absolutely fantastic. It ticks a lot of boxes. And a lot of growth to go for now. International expansion. They've done it in Ireland. Now looking to move into Portugal. There are other geographies that they could make headway. But yeah, well done.
Yep, totally agree. And the next one is a bonkers bargain that perhaps maybe should be re-rated to a stonking small cap, as we'll hear. And that's Time Finance. Is that something that's in the fundamental portfolio or just in the personal portfolio?
I own some shares personally. It's a bit small for our fundamental book, but I declare that I have a small stake in it, and I just like what it's doing. It looks very good value. It's one of our Investors Champions bonkers bargains. It's not an exciting company, and it's an example of maybe getting in at a smaller company when it's very out of favor and being a little bit patient. And it's a lender, so it's an alternative finance provider. It provides invoice financing and asset financing to smaller companies. Loans ranging from 5,000 quid to 5 million. So a big range of them. And it set out a 4-year strategic plan in 2021. It's really delivered on that. 13 consecutive quarters where its own lending book has risen. This is one of our bonkers bargains, but quite frankly, we should reassign it, as I think we've mentioned before, as a stonking small cap, because the revenue grew 20% in the last year, and pre-tax profit was up 41% to 5.9 million. That's pretty good for a sort of value-focused stock. But 13 consecutive quarters lending book up. And when we first picked it, I think the share price was 17 pence. Now it's 55. You know, not the most thrilling stock, but the market capitalization is still only 51 million quid. Rating based on PE multiples, sub 10 times. Yeah, it's forecasting big growth. I mean, it's the PEG ratio, the price to growth ratio, is only approximately 0.5. You've got a lot of growth here could come through. And you can discover value amongst some of the most less exciting businesses, shall we say, being fair to Time Finance. But management have done a great job here.
Can you just expand on the PEG ratio there, Chris? As it sounds like there's a bit of an investing lesson there for us all to hear.
The PEG ratio. So it's a good thing to look at rather than just look at the P ratio in isolation. Which is the multiple of the forecast earnings. People should also look at what's called the PEG ratio, the price to effectively the P relative to the growth. If a company is growing very fast, it diminishes. The PEG ratio is quite low. So if a company's, growing at doubling, the PEG ratio will be a factor. And so one should ideally look at a PEG ratio under 1. If a company's at a multiple, a P ratio of 40 times, but it's forecast to grow 40%, its earnings 40%, that's effectively a PEG ratio of 1.
Brilliant. There's another company here that we've mentioned once or twice as well in the past. AB Dynamics. It's a lovely little company, isn't it?
Yeah, we've held this for a long time, since not long after IPO. Didn't buy it exactly on IPO. It was a real tiddler. It manufactures advanced testing equipment, the automotive sector. It's expanded into other areas. So it does simulation, and it supplies all the big automotive manufacturers around the world in every region. Again, it's just put out a trading update, and this one's grown organically and through a lot of acquisitions over the last few years. But here we look back, when this listed in May 2013, it listed at 86 pence. 2013, 86p. Its market capitalization was 14 million pounds. Nobody was interested. Barely anyone was interested. It then chugged along, and suddenly everybody took a bit of interest. Thought, well, this is quite a nice little business. So its current share price has been higher, but its current share price is £19.39. So get 80p to 19.39, 2,100% return over the period.
Amazing.
Revenue in 2012, the year before IPO, was only 8.9 million. And now it's just said it's going to exceed 110 million. All right, you've had some acquisitions along the way. But yeah, great story, a really great story. The founder brought it to market, a guy called Tony Best. He still owns 25%. So again, common theme, founder ownership there. And he's sold down shares along the way a bit as well. It's just done another deal this week of a German-based automotive supplier. So yeah, good news.
And interesting there at the start, you said it was a tiddler when you first looked at it.
Oh, it was minuscule. That's why, for that reason, the shares were relatively illiquid. We could never make it a really core holding in our book, because the liquidity wasn't great.
Yeah, and there's a couple of companies here that you've mentioned are still tiddlers.
Yeah, so, in the grand scheme of things, we mentioned Time, not big. Elixirr could be a lot bigger. Group, we've already said, look at how big that market is.
1.8%, did we say it was in the market?
Yeah, I know, tiny. It gets it right. It doesn't blow up. And this is always the risk. You have entrepreneurs that can often take things a bit too far, but if the controls are in place, they can do really nicely.
Yeah. Another one that's done really well as well, that Fundamental's been a long-term holder, isn't it? CVS Group, listed in 2007.
Yeah, 2007, £2.05p. Market cap was 100 million. It got to a high of £28.35 in 2021. It actually fell back. I remember we actually came into this one at IPO from one of our accounts, and we should have waited a few years because it fell back to 76p. Then you went right back up to 28 quid. It's now under the cloud of a CMA review into the veterinary services sector. It hasn't been easy. The shares have come off massively over the last few months. They've ticked up a little bit over the recent weeks. But yeah, this is a big old business. Now it's employing 9,000 people. 2,400 veterinary surgeons. It's got over 500,000 members of its Healthy Pet Club scheme. So it's a big player in its market, and it's trying to avoid the glare of the UK by moving into Australia, where it's acquiring veterinary practices as well. But yeah, been a bit of a roller coaster. We would urge people to be patient. Yeah, it looks bleak at the moment, but this is a good business generating lots of cash, investing in a lot in its facilities, investing a lot in its growth in Australia. So, but you've got this CMA review, which we await the outcome of that.
Is there any sort of indication of what the CMA review may say or may do?
No, there's little. I think there's got to be greater disclosure, particularly if the practice is owned part of a big group. That's got to be clear. I don't think that's been that clear. Clear disclosure on pricing so that the customer knows, the client knows immediately how much they're going to pay for things and what other options they might have. But yeah, but I don't know how serious that will be for CVS. I can't see them being asked to sell some sites. The CMA asked them to do that for a few recently. They got rid of them. But now they seek their approval every time they buy something. They're seeking approval before going ahead with the deal. So, but they're adopting a cautious sort of approach in the UK. But yeah, we'll see. It's a bit of a hot topic.
Can't exactly see that being too detrimental. The fact that they've got to say owned by CVS. It'll just be a little logo in the corner of the banners and brochures, won't it?
Yeah, exactly. I mean, it's about giving the consumer greater choice and awareness, isn't it? So there might be a rival practice around the corner. They want to have, it's just got to be greater disclosure and awareness of what their choices might be, I think.
I do feel it's only my circle of influence, friends and family. They treat the vet the same way they treat a doctor or dentist. Once they start going as a pup, that's it. They stay till...
Yeah, you're not going anywhere else.
They're not going anywhere else. So maybe it won't be as
Generally, what great service you get. I know you're paying for it, but what we've said before, what great service. You want to, you could ring up, come in immediately. You get everything done immediately. There's no waiting. And this is the beauty of a private sector operation like that.
Yeah.
And the investment that CVS having to put in. The other factor is vets are not hugely paid relative to their qualifications, and the margins this business makes aren't staggering. It's good repeat business, great cash flow, but yeah, they're still having to do quite a lot now, and there's got to be to upgrade facilities and things. We will see.
And shall we finish off with one of AIM's largest companies and arguably one of the biggest success stories, Jet2? Shares up nearly 500% over the past decade.
Yeah, I thought it was worth mentioning. Who would have thought a business could make a crack of it in this kind of competitive sector? Leisure travel, airline, it's been a disaster for so many people. But here you've got Jet2 is AIM's largest company, 3 billion market cap. The founder, Philip Meeson, still owns a huge stake of it. The shares climbed 500% over the past decade. Compounded average annual growth of 19%. Not many people would have expected that of this kind of sector. Compare it to how others have performed in this area, and a lot of them have been disastrous. So it just shows you've got a market where a business that has managed capital efficiently has thrived and delivered huge returns to shareholders. Again, operating in a massive market. So there was an evident growth potential if it could get it right. And a common theme, the founder was in there. Founder's still got a big stake. And I think if any of the lessons, that's it. Follow the founders. Although it doesn't work out all the time. And we've got a position in a stock called Argentex, an AIM-listed stock, just to put a bit of balance onto things where the founders were running it and one founder left and the other founder was subsequently, shall we say, encouraged to go. And this has been somewhat of a disaster of a share. It's highly profitable. It was highly profitable, but it seems to its structure and operating model under previous founders seem to have hit the buffers a bit. So there's a new team in there now, having to flush things out and restructure and invest for the future, so it can go on to a lot greater things. But it hasn't been an easy share at all. We're willing to be patient at the moment, but it shows occasionally it does go wrong with founders. Sometimes they can't necessarily take the business to the next step, which perhaps has been the case with Argentex, unfortunately. If you've got a long-term time horizon, long-term circa 10 years, you can do incredibly well. But within that 10 years, you're going to have periods of horror stories happening potentially. But if you have faith and the same business models in place, and there may be seething troubles, we had that with U Group, you can see that. They listed, maybe the accounting processes weren't correct, the risk controls weren't right, but look, they've adapted and gone for it and seems to be in pretty good shape. But there are a lot of stories like that. And it is a stock picker's dream. You've got to go through the numbers and often be a little bit of patient. And one of those, Elixirr, that business listed right in the middle of the pandemic. Horrible time. But look, it's gone from strength to strength and hopefully will deliver significantly more growth. But all of these shares have been under pressure lately. Whatever they're producing, however impressive the numbers, and they've been really good, the market doesn't like it, and there have been a lot of selling pressure, largely perhaps around fears around tax changes. People want a bit of their money out, takes them off the table. Inheritance tax pressures as well, with the business relief, fears around business relief. But these are good businesses. And that is the fundamental key to this, is invest in good businesses and they will deliver for you. And they should outperform some of the slow growth dinosaurs on the main market, but they often need a bit of patience.
Yeah. Speaking of the main market, there was a company that you mentioned to me prior to starting a podcast that's done really well. It was an IPO, wasn't it? You mentioned Raspberry Pi, how well that's done. And we debated, didn't we, whether to add it into this podcast because this was more about AIM. But I thought, actually, why not mention it? It's done really well, hasn't it, for a good, successful IPO? And
yeah, it's really refreshing as well. You know, an innovative business from Cambridge. It makes single board computers, microcontrollers, very much focused on the education to begin with. But now it's got a more commercial arm. And I think the key lesson there is, it's, again, managing expectations. It's put out a warning a few months ago saying it was a bit tough, or a bit sort of market, a certain part of its market was a bit soft. It turned out better than it was implying. So better to promise, really, over-deliver.
Over-deliver.
Yeah, absolutely. Manage expectations, communicate and manage expectations, which Fonix has done very well since IPO. So good on Raspberry Pi. Shares have gone and great stuff. They're well off their highs, but they've done terrifically since the IPO in June. Well done to them.
Yeah, so with the exception of Argentex, some really good companies there that have done really well. AIM is more than just a tax break, isn't it?
Yes, certainly. AIM is more than just a tax break. And even Argentex, we hope, will turn things around.
You're still being patient with it.
Being patient. With AIM, don't stick all your eggs in one basket. Spread your risk across a lot of good issues, and you could do nicely.
Yeah. Should we leave it there then, Chris? For another week?
Sounds good.
Well, that's it for today. Please subscribe for next week's episode, as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics, and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.